Module 2, Gross Income, Part 2. After introducing the concept of gross income and its significance and going through a variety of examples of gross income in Module 1, we will now continue by discussing the rules of various other types of income. Annuities, pensions, and Social Security. An annuity is a contract which can take the form of an annuity contract, endowment contract, or a life insurance contract, among others, that provides for payments made at regular intervals, usually monthly, quarterly, semi-annually, or annually, to the owner, also called the annuitant, and/or a named beneficiary. Annuities can take many forms. For example, an annuity may last for a fixed number of years, or until the death of a single person, or until the last death of multiple people, such as husband and wife. The amounts of the payments may be fixed or variable, and may or may not vary based on interest rates, cost of living adjustments, and the performance of the portfolio in which the annuity funds are invested. There are several types of annuities. A fixed period annuity pays the annuitant a fixed monetary amount at a regular interval for a definite period of time. A variable period annuity pays the annuitant for a contingent period of time, such as for the annuitant's life. A single life annuity pays a fixed monetary amount at a stated interval for the life of the annuitant, ending on the annuitant's date of death, while a joint and survivor annuity pays a fixed amount at regular intervals to the first annuitant for his or her lifetime. After the first annuitant dies, a second annuitant receives a fixed amount at regular intervals until death. The second annuitant may receive the same amount or a different amount as that paid to the first one. A qualified pension plan annuity pays a fixed amount at regular intervals. It must meet specific Internal Revenue Code requirements and be approved by the IRS. A tax-sheltered annuity is purchased by a public school or other tax-exempt organization for employees of the organization. It pays a fixed amount at regular intervals. For annuity contracts purchased by the taxpayer, the amounts received from the annuity contract payments must be divided into shares of the payments that represent the return of the principal, called the investment in the contract, and the shares of the payments that represent interest. The interest is taxable income, while the return of principal is not. To calculate these percentages, one must figure out the amount of interest that will be paid under the annuity contract as a whole, as a percentage of all of the payments that will be made under the contract. For example, assume the taxpayer purchases an annuity contract for $10,000. The contract pays out $1,233.38 per year over the course of the next 10 years for an effective interest rate of 5%. The total payments on the annuity contract will therefore amount to about $12,333. Of this, $10,000 is return of the principal, and the remaining $2,333 is interest. Each year, therefore, of the roughly $1,233 the taxpayer receives, $1,000 constitutes return of the principal, which is not taxed. The other $233 is taxable interest. For annuity contracts purchased by employers as part of a qualified retirement plan, the rules are slightly different. Keep in mind that qualified retirement plans are generally funded with pre-tax money. Thus, the full amount of annuity payments received from a qualified retirement plan is generally included in the recipient's gross income. However, if the contributor funded the retirement plan with any post-tax money, for example, if he made contributions beyond the maximum tax-deductible contributions allowed in a given year, then the return of that principal is not taxed. Moreover, many qualified retirement plans impose a 10% penalty for distributions made prior to age 59.5, with certain exceptions. In another course, we'll focus more on qualified retirement accounts and their rules. Pensions and retirement benefits paid by the state government, the federal government, or by private businesses are generally taxed as gross income. However, as with annuities, the portion of the pension benefit that represents return of contributions to the pension made with after-tax dollars is not taxable. Social Security benefits are taxed in a more complex manner. The general rule is that while Social Security income is subject to income tax, only part of the benefit is taxable. Social Security includes monthly retirement benefits, survivor and disability benefits received from the Social Security Administration, and survivor and disability benefits received as a Tier 1 railroad retirement benefit. For single taxpayers, If the taxpayer's gross income is between $25,000 and $34,000, 50% of the Social Security income is subject to federal income tax. If the income, including the untaxed Social Security benefits, exceeds $34,000, 85% is taxable. For married taxpayers filing a joint return, the 50% rules apply to income between $34,000 and $44,000 of income, and the 85% to income above $44,000. IRA disbursements. Since contributions to a traditional IRA are deductible from gross income, amounts distributed from the IRA are taxable income. In addition, there's a 10% penalty if disbursements are made before the owner attains age 59 and a half. While the account holder need not start taking distributions immediately at age 59 and a half, the tax code requires the account holder to start taking taxable required minimum distributions, starting no later than April 1st of the year in which the IRA owner attains age 70 and a half. This is called the required beginning date. The amount of the annual required minimum distributions depends on the age and thus life expectancy and marital status of the account holder. If the owner of the IRA is unmarried, the owner must begin receiving required minimum distributions based on the life expectancy tables provided by the IRS. The required minimum distribution is the percentage of the account that is 1 divided by the remaining actuarial life expectancy of the account holder. For example, assume Mary was born on June 1st, 1950, so she attains 70 and a half years old in 2020. She must begin receiving disbursements from her IRA by April 1st, 2021. Assume her IRA account balance on December 30th, 2020 was $50,000. Based on Table 3 in Appendix B of IRS Publication 590B, the life expectancy for someone her age is 26.5 years. Her required minimum distribution is therefore $50,000 divided by 26.5, or $1,887. This amount must be distributed to her by April 1st, 2021. On April 1st, 2022, she's now 72 years old, making her life expectancy 24.7 years. Her minimum required distribution for that year is 1 divided by 24.7 times whatever the balance of the account is on that time. When the IRA is taxable over the joint lives of husband and wife, the required minimum disbursement is based on their joint lives, the distribution periods for which are published as Table 2 of the same IRS document. For example, assume Mary was born on June 1st, 1950, and so attains age 70 and a half years in 2020. Her husband, Sam, is 15 years younger than she, and so is only 55 in 2020. The IRS provides a table that lists the distribution period based on their joint lives. Mary's IRA account balance on December 30th, 2020 was $50,000. Based on Table 2 in Appendix B of Publication 590B, the distribution period for the joint IRA for Mary, age 72, and Sam, age 56, is 30 years. Her required minimum distribution is $50,000 divided by 30, or $1,667. This is the amount distributed to her on April 1st, 2021, her required beginning date. Distributions from Roth IRAs, on the other hand, are not subject to income tax. This is because contributions to Roth IRAs are not deductible, and so are made with after-tax dollars. The tax-free distributions from the Roth IRA, which apply to both the contributions and all growth on the contributions, is what makes this one of the best tax planning retirement tools. There is no required minimum distribution from a Roth IRA, and so no mandatory age when payments must begin. There is a 10% penalty if disbursements are made before the owner attains age 59 and a half, with certain exceptions, most of which apply to the traditional IRA as well. However, withdrawals can be made from a Roth IRA account before that age up to the total amount of the contributions. Almost all types of qualified retirement plans, including traditional and Roth IRAs, have limitations on contributions, and many have income limitations on who can participate in these devices. The traditional and Roth IRAs are limited to annual contributions of $6,000, total between the two types of IRAs, per person per calendar year. If the owner is over 50 years old, the code allows for an additional catch-up contribution of $1,000 per year to make up for years the full contribution limit was not met. Roth IRAs are subject to the following income limits. For 2019, an individual taxpayer can only contribute to a Roth IRA if that person earns less than $137,000 in modified adjusted gross income. Married taxpayers filing joint tax returns can contribute to a Roth IRA if they earn less than $203,000 of joint modified gross income. There are no income limits for contributions to traditional IRAs. However, there are income limits for those who wish to take tax deductions for the contributions. Those income limits are similar to those for the Roth IRA. People who earn too much to contribute tax-free dollars to the traditional IRA can contribute post-tax dollars. This at least allows the money to grow tax-free until the monies are eventually withdrawn. Moreover, withdrawals up to the amount of post-tax contributions can always be withdrawn tax-free. Miscellaneous taxable income. In the landmark decision of United States v. Kirby Lumber, the Supreme Court ruled that debt that is canceled or forgiven is taxable as income. This decision has been codified in the Internal Revenue Code. Thus, when a taxpayer settles a debt by paying less than its full value, such as, for example, an agreement with the bank to settle credit card debt by paying less than what is owed, the difference between the full value of the debt and the amount paid to satisfy the debt is taxable income to the taxpayer. Government entities, banks, and other entities engaged in the business of lending money are required to report to the IRS canceled debt worth more than $600. A partnership does not pay federal income tax. The income and deductions are passed through to the partners based on their percentage ownership in the partnership. The partnership files an informational return with the IRS, a Form 1065. The return includes a Schedule K-1 for each partner that lists the distributive share of the taxable income and deductions allocated to each partner based on that partner's percentage of ownership in the partnership. The amount listed on each partner's Schedule K-1 must be listed on the partner's personal federal income tax return. The income a deceased taxpayer would have received had the taxpayer not died is income in respect of a decedent and is taxable income to whoever does receive it. This includes unpaid salary, wages, deferred compensation, commissions, stock options, vacation pay, sick pay, accrued interest and dividends, uncollected rent, accounts receivable owed to the decedent, and sale proceeds from the sale of property that occurred before death, but the proceeds were not collected until after death. Taxpayers who typically report income in respect of a decedent may include the decedent's estate, which itself becomes a taxable entity, or the decedent's beneficiaries, if the assets have already been allocated and distributed. A decedent's estate, or an irrevocable trust, are considered their own independent taxpayers for federal income tax purposes. Estates and trusts receive the same types of taxable income as individuals and corporations, and are required to file federal income tax returns in years in which they earn at least $600 of gross income. They file their own income tax returns, Forms 1041, and pay their own income taxes on monies that they retain. They can deduct any amount of income that were distributed to beneficiaries, in which case they distribute Schedule K-1s to the beneficiaries, and the beneficiaries are then taxed on that income. For example, assume an estate had interest income of $2,000 for a taxable year. The estate distributes $500 each to beneficiaries A, B, and C. The estate must distribute K-1s to A, B, and C, who will then each report $500 of income. The remaining $500 is subject to income tax of the estate, though since it's under the $600 exemption, the estate will not actually pay income tax. Constructive receipt of income. The constructive income rule mandates that taxpayers realize income, even though it has not been physically received, when the taxpayer controls or can use the funds or property, or is guaranteed to be able to access it in the future. For example, income is constructively received when it is added to the taxpayer's bank account, or made available for withdrawal, or when the taxpayer is notified that she can withdraw the funds at any time. For example, if an employee receives a paycheck on December 15th but does not cash or deposit it until January, that paycheck is still taxed to the employee as income of the first year, because it could have been cashed or deposited in December. There is no constructive receipt when the taxpayer's receipt is restricted or subject to substantial risk of forfeiture. Property is subject to a substantial risk of forfeiture if the receipt is contingent on a future event. For example, an employee's year-end bonus would not be considered constructively received if it is contingent on certain revenue goals being accomplished, when those goals won't be measured until January. Note that life insurance premiums paid by the employer are taxable to the employee when the employee has the right to transfer ownership of the life insurance or when the ownership of the policy is not subject to performance of future services. Non-taxable income. Gross income is taxable unless excluded by a section of the Internal Revenue Code. Sections 101 through 140 list items that are excluded from gross income. Let's look at some of the most important of these. Section 101 excludes from gross income proceeds of life insurance contracts that are paid upon death. To qualify, the recipient must have an insurable interest in the life of the deceased person, which typically means a close familial or business relationship. If, for example, an investor purchases a life insurance policy on an unrelated person, the death benefits are taxable to the extent that they exceed the investor's purchase price, because the investor doesn't have an insurable interest in the deceased person. Section 102 exempts gifts and inheritances from income tax, though they may be subject to gift tax or estate tax under other sections of the code. Gifts given by employers to employees are considered taxable even if they are nominally called gifts, a rule that prevents disguising wages or benefits as gifts to avoid income tax. Other common items of income excluded from taxable gross income include compensation for injuries or sickness, usually won in lawsuits or settlements, payments received under accident or health insurance plans, contributions by employers to accident or health insurance plans, the rental value of a parsonage in which a clergy member lives, even though it's part of the compensation for services as clergy, a discharge in debt that occurs as part of a bankruptcy case that occurs when a taxpayer is insolvent or in certain other cases. This constitutes an exception to the general rule we discussed earlier that debt discharge is generally considered taxable income. And finally, tuition scholarships or fellowship grants that reduce tuition at qualified schools. In our next module, we will turn to deductions by looking at income tax deductions that are available to individual taxpayers.